UBS has made some bold claims about where the economy and stocks are headed. They're suggesting that if negotiations between the US and China don't go so well and continue to fall apart as they have been, this economic slowdown will fall into a contraction. The longer this persists, the more pronounced it will be. Monetary stimulus will begin and confidence will be lost. Once the mass layoffs begin, the earth will rumble under the heels of the angry mobs. You came here for the truth, so let me unveil that for you. Today we're going to look at some economic statistics that I think are very important for you to keep an eye on. I'm going to talk about the US and China trade issues. Obviously with the G20 coming up, this is extremely important. We're going to look at what UBS said. I'm going to show you some charts. I got some articles, a lot of detail to cover. Let's begin right away. UBS. The globe is headed for a recession and bear market if this week's US-China trade talks fail. We've been waiting for this moment time and time again. We are always holding off and waiting until that next meeting, the next event between the two of them. The trade talks are going to be anything and everything for these markets, and then something falls apart. And we are waiting for the next one, and so on and so forth. While escalation isn't what UBS expects, a failed trade meeting between the US and China would mean big changes to GDP expectations. Already the GDP numbers are heavily manipulated, but even when you look at the actual growth and contraction on their own indicator, then you can see how as time goes on, every dollar that they pump into the system gives you less on the way out. Okay, so the way I want to explain that is basically if they have been injecting mass amounts of quantitative easing, if they've been deficit spending like crazy, they're going into debt on every level. This has been the case now forever. However, in recent years, they've been multiplying the amount at which they have done this. Yet, we're getting less output as a result. And you could see the year-over-year growth is slowing down. That's been going on for decades despite record stimulation. UBS estimates that economic growth would be 75 basis points lower over the following 6 quarters and resemble a mild recession. Okay, so they don't want to go out there and suggest that it's going to be something crazy and everybody's going to be freaking out. Don't worry, just a mild recession. And even if that's the case, people need to know what to do with their money. The actual big portfolio managers, the hedge funds, all these big guys, they are starting to reinvent their portfolio. They're not putting all their money into FANG stocks and hoping for the best. They are always changing what they are investing in, and this is one of those times. This chart here is just showing you the growth impact of US-China tariffs on the world. So you can just see it for yourself. Basis points into the negative on the left-hand side, just showing you there how it's all broken down. I don't want to get into all the details, but I wanted to just give that to you as part of this article. Traders blame the worsened trade outlook for an equity pullback in May. This is why they wanted to have the Federal Reserve come out and give them a little injection. Give me a little bit of that drip. I need it. I need something right now to have the positivity in order to bring the markets higher, just a little bit higher. Just give me one dose so I can have what I need. Further aggravation of the trade conflict could push global equities down 20%. Now, I'm not saying it's going to go down 20%. I am simply quoting here, okay? So you need to understand that they make these predictions. I simply collect them and bring them to you. And at the bottom, in global sectors, materials stands out as the most vulnerable, but some defensive and crowded segments are also at risk amidst weaker growth. For a bottom-up perspective, we lean on our prior work to highlight trade and crowded growth exposed stocks. I've talked about this before somewhat, just showing you that there are a bunch of stocks, a group of stocks that are obviously going to be exposed to what's happening here. The chip makers have been one very important group to be careful about. However, if the trade talks go very well and things start to look fantastic, that would be one that you could see coming up and rising in the short term. Now, what's going to happen to the global economy with so many different activities that are going on today? I don't know about that situation, but specifically for what we are discussing in this video, it's important to watch the chip makers as one group. Top U.S. exports to China as a share of total U.S. exports of each good. And the dotted red line is soybeans. So you could see the percentage terms looks like almost 60%. This is a very important commodity for both U.S. and China. China has to import a large quantity from the United States. Back in 2018, even when the tensions were pretty high, there was a confirmation from China suggesting that they were going to buy a lot of soybeans. Then in November, I believe they bought nothing at all. Even in the months surrounding that, it wasn't looking good at all in terms of the amount that they were importing. They must be getting it from alternative sources, but the US is a major contributor to the exports to China. Now we're looking at the MSBCI, which is Morgan Stanley's Business Conditions Index, and that has head down, basically fallen completely off a cliff. Look at the blue line here on the left chart. It's crazy to see how significant this drop has been. That is completely in conjunction with the PMI, as you are seeing here as well, the yellow line and the green line, just showing you that all of the conditions have weakened from 2018 into 2019. It's not just one indicator or another. We have seen this time and time again, how this has all played out. Empire and Philly Fed surveys are confirming that ISMs are likely to be weak, just showing you that here. You can see both of these. While they do fluctuate up and down, it is apparent right now that this weakness is here for the foreseeable future. We need some serious progress with this meeting. That's going to happen at the G20. If they're unable to complete that, if it doesn't look positive when they leave this moment, it's going to be detrimental, at least in the short term, to stocks as well as to the economy. Now, the stocks are going to be really focused on the Federal Reserve. If they don't get what they need in July from the Fed, a little bit of that drip, a little bit of that injection, this is going to be a major downturn for them in that short term. Then, of course, they can cut rates. That's all up to them. So we'll see what happens. Cass Freight Index year over year now at a critical level. Any further and it might be signaling a recession. This is just showing you something I had just shown you a couple days ago. In fact, looking at the Cass Freight Index year over year having come down. This is all in connection with the other shipment related indicators that I have shown you. Just about all of them are moving downward. This is air freight, Cass Freight, any sort of freight is down at this time. The big truck orders are down. We are seeing a response to what's happening, not just with China and the US, although that is affecting businesses clearly. You look into it deeper and you realize that this is a global economic slowdown. This is what I'm talking about right here. The last ADP report showed net job loss among small firms and very little job growth among medium-sized firms. Of course, we will see if this is a trend in the next report coming in the next couple weeks. This information is coming out of the Dallas Fed, just basically showing you the conditions, and it isn't looking very good. An indicator that measures perceptions of general business activity in the economy was -12 in June. Negative readings indicate that more executives feel pessimistic about the economy than optimistic. More than half of the manufacturers surveyed said that the tariffs have increased their input costs, and more than a quarter reported reducing capital spending as a result. That's called a slowdown. And with all of the insanity going on right now, gold has seriously seen an upswing that it had been unable to break beyond for such a long time. So now around $1,400, actually exceeding that, and it hasn't been at this level since 2013. So this has been the recipient of an inflow of capital because of the trade tensions, because of the concerns going on in different countries, the chances that things will be worse off, and you know that this is considered to be the safe haven, but ultimately where it stops, nobody knows. Will it be able to achieve the highs that it did before? Only time will tell. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a like, you're supporting me. All you gotta do is click one button. There's a like button. You click it, you're supporting me. That's it. Thank you very much. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. You can get all the details at the link in the description. Check them out. And if you want the audiobook, that's available at themoneygps.com. The I Love QE t-shirt has been made at the request of so many subscribers. They wanted a t-shirt that said I Love QE, so I did just that. There will be a link in the description. You could look there under t-shirts, or you can go to teespring.com/ILoveQE. Thank you very much for all those out there supporting me and this channel. If you haven't seen this video already, definitely 100% check it out because it is just booming right now. Click on it and I will see you there.